I promise this isn't going to turn into a finance channel, but this is something I've been quite passionate about, so I thought I'd do a video on it. I'd also like to shout out Stephan. I've been watching his videos for a while and I've seen him absolutely blow up on YouTube. And also he's the one who got me into thinking about my own finances and how to plan for the future. And I'll link his channel in the description as a thank you for helping me get my life together. And hopefully by spreading the word, he can help some of you guys too. I've kind of condensed a lot of what he talks about into this video. To make this guide. I feel like this channel was to talk about things that I sit and think about, and I feel like this falls under that category, so let's get into it. This is not financial advice. This video is purely for entertainment and is my own opinion. I'm not telling anyone how to spend or invest their money or what financial decisions to make. Take the contents of this video as entertainment and at your own risk. So I've decided to start a monthly ultimate series where I talk about a random topic where I don't mention how alone and dumb we are as a species. And seeing as I've already failed, let's continue with the first episode in the series. All you need to be financially free is to have money. No, but seriously, there is no better way to make money than if you were to already have it. The more you have, the more you can generate. Wealth creates wealth. Okay, we all know that the rich get richer, but here are the steps you need to take to become financially free. Welcome to The Thinker. In order to be considered financially free, you would need to first figure out how much money you need per year to pay for all of your expenses. Take this expected annual expense for your ideal lifestyle and times that number by 25, and that's the amount you would need in assets. On that amount, we are essentially expecting a 4% return, whether it's invested in stocks, real estate, or ideally from a mix of diverse sources. At this point, you no longer have to work as your money and assets do all the hard work for you. Accumulating 25 times your annual expenses seems insane, but let me tell you why it's not as bad as it sounds, and how to put yourself ahead of the curve, and be sure to watch the end for some bonus tips and tricks. But for now, here are 5 ways to help you become financially free. Number 1, perception. In order to be sustainably rich, you need to stop seeing money as money. Instead, what you should see is how much that money could generate you over time. As I said earlier, wealth creates wealth, but it's okay if you only have a little to start with. It's your attitude towards money that matters. Most people will see 100,000 as a life-changing amount, but if the recipient doesn't have the right attitude towards their finances, then what you typically witness is a pretty quick change in their lifestyle. New clothes, new car, new phone, fancy restaurants. Now there's nothing necessarily wrong with any of this, after all it is their money to spend, but the problem remains that spending like this is not sustainable, and so once that figure dwindles, which it will, the recipient will have to somewhat return to their previous lifestyle. The difference is most rich people don't see 100,000 as a 100,000 lump sum. They will see it as an increase of around 8,000 a year to their current lifestyle. Because this is what the principal could generate when invested in an exchange traded fund such as the S&P 500, based on annual historic growth since 1957. Or they might see it as around 10 grand a year when used as a deposit for rental property accounting for costs. They mentally reduce this life-changing figure in their heads and only see it as an increase of 500 to 1,000 a month, and will only increase their lifestyle expenses up to that amount. Unlike the first example, this is highly sustainable because you're never spending any of the original 100,000 that you've invested. It's no longer enough to make money if you want to be rich. You have to make enough money that it makes you the money that you want to make. Once you start seeing that £10 note in your pocket as 70p a year, you'll start to quickly realize just how much you need to save to make a difference, and what silly expenses you need to start cutting out of your life. Number 2, emergency savings. Keep some money in a quickly accessible high interest ISA or savings account and keep anywhere from a quarter to half your annual income. Life is full of unexpected twists and turns, and recent events just goes to show we never know what's waiting around the corner, and it's better to have that peace of mind that you've prepared for these situations. And whilst we can't be sure of what kind of unexpected expenses will come our way, we can be sure to expect them. It can really set you back in your journey to be financially free, especially if you get hit with unexpected expenses and you just don't have the liquidity to manage due to poor planning. Number 3, aside from emergencies, don't save. You may think investing is too risky and it is safer to keep it in the bank where it's not at any risk, but the truth is, whilst your money will be safe in a bank account and what you deposit won't fluctuate, the spending power of this money will not be the same 10 years later as it was when you first deposited it in your account. And the reason for that is inflation. Inflation is causing the cost of goods to increase year on year at an average annual rate of roughly 2% since the 2008 financial crisis. So your principal would have to generate 2% in interest annually just for your money to hold its current value. That's in order to buy you the same things in the future as it does now. However, 0.5 is the average interest rate set by the Bank of England since the 2008 financial crisis. Whilst it doesn't necessarily reflect the actual rate your personal bank may give you, it does give you an overview of the problem. The number in your bank account might be going up when you get those interest rate payments, but it will have lost value when it comes time to spend it. Number 4, this is why it's important to invest. Investing in real estate, rental properties, or exchange traded funds known simply as ETFs, such as the S&P 500, which as mentioned earlier, historically has a return of 8% annually, which by the way you can buy commission free on platforms such as Freetrade or Trading 212. I'll leave my referral link for Freetrade and Trading 212 down below in the description, where we can both get a free share when you sign up and deposit as little as £1. If you decide to do that, make sure to let me know what free share you get in the comments. Exchange traded funds such as the S&P 500 are highly diversified. It consists of 500 of the largest US companies, and when you invest you are buying a small piece of each. Broad index funds like this give you more security because even if a few of the companies in the S&P 500 were to completely tank, the high diversification means that you may still be in profit if the majority of the other companies have all experienced market growth. ETFs are a much faster way to achieve portfolio diversification than to build a diverse portfolio with individual stocks. Although you may still opt to study the market and buy shares of individual stocks, this strategy is higher risk, and each investment would depend on the success and failure of an individual company, as opposed to the risk being split across 500. If that one company goes bankrupt, you may lose your entire investment. In addition to this, majority of professional traders who spend their lives trading are outperformed by the S&P 500. The key is to invest in a broad index fund consistently each month, reinvesting the dividends and not allowing the short-term market fluctuations to cause you panic. So let's say you've identified that you need $60,000 a year to have your dream life. Well, you would need to have $1.5 million to be considered financially free. If this seems unattainable, then this is why I'd like to welcome you to the magic of compound interest. Over a 20-year period, weekly investments of £50 into the S&P 500 with that annual return of 8% would result in £128,499.60. From what would have otherwise been $52,000 had you chosen not to invest it. That's more than 100% return on your investment. The longer you hold it, the more you make through compound interest. That's why it's so important to start early and hold for at least 20 years. Number 5. Other things you want to do is to try and increase your passive income. Write a book, start a YouTube channel, make use of referrals and affiliate marketing by putting your referral link for commission-free stock trading in the description. As well as increasing income, you also want to reduce costs where possible. If you're not tied into a contract, it might be time to call your phone network and negotiate better terms, or even switch to a better provider. Do the same for other services like Wi-Fi, etc. Because new deals are constantly popping up, and so these providers tend to be accommodating just to keep your custom. And if you want to see me be a complete hypocrite, wait till the next video to see what I've spent 10 grand on. That's all I have for you today, so thank you for listening. If you found this useful, please press all the buttons. I'd like to say a big thank you to my patron who's on the screen now. If you also want to support me on Patreon, the link will be down below in the description. Thanks again, and as always, like, subscribe, comment, bell. Oh, so also, for those of you who've been wondering where I've been all this time, it's actually a really simple explanation. It all started